Hello, everyone. This is Dylan Moore with the Volitional Science Network. I'm here with economics junkie Nima Majur for our third round of MMT for Conservatives, where we will continue to explore the statist origins of money and the implication that has on our economic system. And we also have with us today a special guest, and he may be the most special of guests when it comes to this subject of MMT. We have Warren Mosler with us tonight. That's right. Warren is the founder and the leading voice in the field of modern monetary theory. In addition to being an economist and theorist, Warren is an entrepreneur and a financial professional with a whopping 40, that's right, 40 years of experience gaining insider knowledge of monetary operations. He is also the author of The 7 Deadly Innocent Frauds of Economic Policy. He is attributed to creating Mosler's Law, which states there is no financial crisis so deep that a sufficiently large fiscal adjustment cannot deal with it. And he is also a potential candidate for the governor of the U.S. Virgin Islands. Thank you very much for coming on with us tonight, Governor.
Thank you. Thank you. Good to be here.
And then, Nima, thanks as well for coming on.
Happy to be here.
Let's get your face showing up on the recording. So, Warren, one of the things we wanted to start with is what I've noticed when talking to people about this. I'm a recent convert. Nima converted me with your book the day he met me, and to MMT. Why is this subject so distasteful in general to conservatives, in your opinion?
Well, I don't know. First question you asked me, you've got me stumped. I know conservatives like Michael Johns, who founded the Tea Party, and he's been trying to impress them with this for a long time. He wrote an article in 1996, I believe, published by the Washington Post, about why the budget deficit isn't the problem, they think it is. And he's as conservative as they come. So I guess it depends on who you speak with.
Or why aren't his followers listening to him? In your opinion?
Yeah, they're not. And his biggest disappointment with the Tea Party has been that the Tea Party was taxed enough already. The idea is to, reduce our taxes. It's not to bring down the deficit or pay off the debt. And yet somehow it evolved into that. And he had me speak at some Tea Party events, and I got very good responses. But one thing I noticed is that they're basically Republicans, and as part of the political system, two-party system, it's our team against their team, and I think that's one of their team has gotten on this. The debt's bad, balance. Reagan was on saying if it gets to 90 billion, we're all doomed, and they're all like that team. That's one of the things they do, and so. They, on an individual basis, they're just not going to look beyond that. Okay, so somehow you got to get the team to change from the top down. It's probably unlikely to change from the bottom up. That's true of the Democrats also. You've got Bernie Sanders doing Medicare for all out there with a big, huge, whopping multi-trillion-dollar tax to pay for it. But if you look at Medicare for all, whether you like government health care or not, it's a massively deflationary event. People in the private sector will lose their job because the administrative needs drop. The number of people employed in administration, drop dramatically. We've saved maybe $1 trillion of expenses as a nation. And people out of work because of a Medicare for all policy, taxes, you lower taxes, or you increase public spending, again, depending on your politics. So here's the Democrats coming out with a program that's highly deflationary, and they slap on this tax, which kills it. Hillary Clinton says, look, that's Bernie Sanders. He's Santa Claus. Pay for it. We can't afford this, so we're going to go with Obamacare. And 2/3 of the Democrats go with that. Okay, so it's Republicans and the Democrats are pursuing the same mistake, let's call it. Why people are so hard to convince is because their immediate leadership is telling them the opposite. And they can't figure it out. So, if they have to just take somebody on faith, it's going to be their immediate leadership. because it's their team, and they've been fighting the other team for a long time. And they've been fighting the evils of the other team for a long time, or what they believe are the evils.
One of the issues that I've seen, because I've since I understood it, and I had a day that it clicked for me. When I've started talking to other people, and I'm using kind of a pop culture version of when I say the word conservative, is the conservatives seem to be thinking that you're talking about what should be. When you say, okay, the we need more public spending or else we'll shrink the deficit and there won't be any money. They say, well, no, that government shouldn't be spending and they shouldn't be taxing. And it's like, no, we're not talking about what should be. We could talk about that after we talk about what the case is right now.
Okay, so it's worse. You can hear my interview. It's true and worse. I was on with Stuart Varney on Fox News several years ago.
Yeah.
And, he was supposed to have Paul Krugman on who couldn't show up or something. So they needed somebody.
You're Paul Krugman's replacement. Sorry. Go ahead.
So they wanted somebody who was in favor of a larger deficit. So they took me because I was in favor. And he says, so you're in favor of a larger deficit? I said, yes. My first proposal is a full payroll tax holiday. Okay, that's $1 trillion tax cut. And the tax is taking this money every month out of people's paychecks. The average family will have an extra $625 to spend, which will mean, the banks won't need a bailout because people will be able to make their mortgage payments. The car companies won't need a bailout because people can make their car payments, and we'll have a normal economy. This was in 2008, right? Sometime in the middle of 2008. So he says to me, he says, oh, you're one of those big spending liberals. Okay. I just hit this guy with $1 trillion tax cut, larger than any conservative ever imagined, right? Not a penny of government spending. And you're a big spending liberal. And the guy with him goes, well, he's talking about a tax cut, Stu. You go, oh. Okay. So they don't even hear you.
I'm not even listening to what you're saying. I'm just going to say stuff back at you.
Yeah. So that's what we're up against, right? So that's what the conservative side was looking at. You say we need a larger deficit. They hear you're a big spender. Okay, I'm talking about a tax cut. Taxed enough already, right? To this guy. And, the first thing that comes out is you're a big spending liberal.
Well, one of the things that I try to focus on when I talk to people is I say, look, I understand this is going to sound crazy. Just listen to me. Yeah. And the reason that this is going to sound crazy is because when we have a couple words, and the three big ones are debt, deficit, and surplus. When we talk, they have opposite meanings for the currency issuer.
Okay.
I mean, I don't know if opposite is the right term. Yeah.
Here's how I've been saying it more recently.
Mm-hmm.
The national debt, the public debt, is nothing more than the dollars spent by the government that haven't yet been used to pay taxes. And they're sitting in somebody's account in at the Federal Reserve Bank until they get used to pay taxes. That's all it is. The dollars spent that haven't yet been used to pay taxes. They go like, what's your problem?
Well, okay.
Well, they haven't.
So let me pull out my retorts to that.
Yeah. Sure.
So then why do we have to sell government bonds to fund our spending?
Okay, number one, we don't. So the question is, why do we? And the reason we do is because when we were on the gold standard, all the money we spent was convertible into gold. And so if we spent money without taxing or we spent money without selling bonds, or had gold certificates, they could cash them in, the Treasury could run out of gold, and the country would go into default, which happened in many countries, on the gold standard. It runs on the banks. It's the whole problem with the gold standard. Once we go off the gold standard, that whole rationale is gone. Now there is no more reason to sell bonds. So when you're on a gold standard and you spend money, when you sell bonds and they buy the bonds, now they can't cash in the money for gold anymore until the bonds come due. You've deferred their ability to get your gold. And so you have to pay them an interest rate to compensate for that deferral. And the market will decide that interest rate, not the government. And the market might say, okay, we'll buy your bonds at 5% rather than cash our money in for your gold. Or 4%, or 3%, or 8%, or 200%, as happened in Russia in 1998. So, but there's a market rate for the risk, or for the, Treasury trying to sell bonds, which is trying to keep convertible money from being converted. And instead, hold these bonds at 6%. Don't convert to gold. Hold these bonds at 8%. Don't convert to gold, whatever the market rate is. Okay, well, that's all gone once you're off the gold standard. More important, but they do it anyway. They spend the dollars. People have dollars that are not convertible. The only thing you can get for a $10 bill now is 2 5s. You can't get any gold or anything. All right, and yet they sell bonds so that people then don't have the money to convert into gold, or whatever the original reason was. It's been totally lost. It's an anachronism, but they're doing it anyway. And they've made up a reason for it.
Oh, yeah. Okay.
They made up a reason saying, well, the bonds prevent inflation. Well, that's not true at all. It's got nothing to do with it, because when the Fed bought all the bonds back for us and put the dollars back in our accounts, over $4 trillion, inflation didn't go up. If anything, it went down. So, that disproved that theory. Not that it needed disproving. To me, it was obvious. It never made any difference. I've been saying this for 20 years. But this whole thing about selling bonds is just momentum.
And
political momentum.
Steve from Real Progressives said the other day, at this point, selling bonds and having a risk-free rate is basically just a basic income for the rich, if that makes sense.
Yeah, I started saying that, but I didn't quite say it that way. See, I said it's like basic income for people who already have money.
With cash, yeah.
And I said, not selling bonds, but a positive interest rate policy.
Yeah.
If you have a zero rate policy, people who have money get zero on their money.
Yeah.
If you have a positive, risk-free. If you have a positive interest rate policy, people with money get that much free money from the government. Okay, so it's like basic income. A positive rate policy was my original statement, is basic income for people who already have money. And that's true. That's just the observation of what it is. And so why are they doing it? Is that why they're doing it? I don't think so. They're doing it because they think somehow it prevents inflation, but again, it doesn't. That's another myth.
So do you suspect incompetence or conspiracy?
Well, that's the whole thing about innocent fraud. Which is worse? How are you being more insulting, by calling them innocent, or by calling like you too dumb to know this, or you're conducting a fraud? So that was kind of, and that was from John Kenneth Galbraith in his book about innocent frauds. I like the term, and I gave him credit inside the introduction for the term. But yeah, I think it's more damning to call them ignorant than to call them, frauds or conspiracy. It's more insulting or whatever.
I'm glad that was your primary intention when you were coming up with the. I don't know what you're doing, but I want the thing that's most offensive.
Yeah, right. So, but I think that, I don't know, but it makes the point that they're either totally stupid or they're involved in some fraudulent conspiracy.
Now, I have another question on this for you. You have firsthand experience of what went on during the 1980s when the Federal Reserve hiked rates pretty substantially, and in order to fight inflation. And what would you say, in your experience, what was the actual effect of what happened back then?
So, which is a great irony. So they raised rates, and to me, that prolonged the inflation. It didn't bring it down. It made it last longer than it would have otherwise. And what broke the great inflation was the deregulation of natural gas in 1978. That allowed the natural gas wells were all capped because the artificially low price on it, where it wasn't profitable to pump natural gas. So it was, 30 or 50 cents or something. And after they deregulated, it went up to $2.50, which people maybe were upset about because they're making profits. But suddenly there was natural gas all over the place, and it was available to the public utilities. So you had people like Florida Power and Light switching from oil, which had been dirt cheap before it got expensive, to natural gas. This is 1978. And the supply shock was like 15 million barrels of oil a day. OPEC cut production by something like, over a period of time, 15 million barrels a day to try to keep the price over 30. And it wasn't enough. The price collapsed to 10. And if you look, the inflation, to me, was obviously caused by the price of oil going up went from $3 in the early 70s to $40 by 1980. And so when you have oil going up that high, that fast, 10, 12 times, that's like today, oil going from 60 to 700. Okay. All those prices get passed through. You report higher prices. People call that inflation. I'm not saying that's the correct definition, but it shows up as consumer prices and everything else. Called inflation. It wasn't due to excess spending or depreciating the dollar. It was due to monopolists raising the price of oil. And that all got passed through. So when the price collapsed from 40 to 10 over a couple of years, that's what brought the inflation down. Okay, so today when the price of oil goes down, we immediately go from inflation to deflation for those months where the oil's going down. Well, our interest rates are low. Back then, interest rates were so high, 15%, 18%, 20%, that even with the price of oil breaking from 40 to 10, inflation was coming down, but only slowly because the high rates were supporting the inflation rate. Look at why high rates support inflation. There's a couple of different reasons which the Fed and the buzzword is there are different channels from high rates to inflation. So one of them is the idea that, like, if you're going to buy a house and the builder's building it and he's figuring out the cost to build the house and interest rates he's got to add that to the cost of all the materials and everything else for the time it takes to build the house. So if it takes a year, he's got to borrow money to buy all these things, pay 12%. That gets added into the cost. So interest rates get added into the cost of doing business. People have to keep inventories on hand, all kinds of things. That adds to your cost, and it affects all businesses. And so those cost pressures raise prices, but that cause prices to tend to be that much higher. Okay, so you have that channel. The other channel you have is what we just talked about. People with money, you got $100, a year later you got $112 or $115. The government's just pouring out all this interest income to people, and it's not producing anything for sale on the other side. It's all demand, no supply. Right? And so between those two factors, the high rates are supporting inflation, and it took 10 years for the inflation to come down from 12% to 3%. And because they left rates high and brought them down only very slowly and gradually as inflation came down, because they thought the high rates were keeping inflation from popping up again. 10, there were no more cost pressures to push inflation up other than interest rates.
Warren, can I try to that was a ton of information that you just laid down. Can I see if I can try to condense that? No, that was great. So essentially,
all right. Well, let me give you the irony.
Okay.
The irony is the great inflation. Paul Volcker gets credit for curing the great inflation, when in fact, he prolonged it. Where Jimmy Carter, who actually broke the great inflation with his deregulation of natural gas, they're both still alive today. And Carter still thinks it was Volcker, and Volcker still thinks it was Volcker. And, I'd like somebody to tell them while they're still alive. It could be kind of interesting to see their reactions.
So to boil that down, there's a typical feeling or a typical sentiment that raising interest rates causes deflation, because the idea is that you're paying off the debt and you're removing money out of the system, when in reality, you're actually paying more on bonds that's introducing more money into the system, and it's doing it for nothing, right? It's just giving people with money more money, while simultaneously making everything more expensive, because we're all buying houses and starting businesses and borrowing money.
It's adding to the government spending. It's new government spending. Every time the Fed raises rates, they're adding to government spending. Their rate increases. They've added, $70, $80 billion a year to government spending, which has helped support the economy and support inflation. It's in a small way. It's only 1% or so. But it's still, that's the direction that they're doing it. It's backwards. They've got the brake and the gas confused. And they think they're stepping on the brake when they're stepping on the gas. So when the car doesn't slow down, they just step on it harder. Go ahead.
Would you say that because I imagine, for example, if risk-free rates are raised very quickly and very sharply, I wonder if it might not also have some sort of effect on the loan market in terms of here's how high marginal borrowers are willing to accept rates to be. If we go past that, then we're actually clamping down on loaning for no real reason other than we've arbitrarily raised the rates. Is that
you're exactly right. Okay, and that's their argument about why it's supposed to work. So now let's just look at the actual dollars, in dollars out.
Or before you do that, can I try to dumb down what Nima just said?
Yeah.
And make it a little more real. My goal here is to, if you guys get too technical, to try to bring it down a little bit. So I think a perfect example that would describe what Nima just said is, let's say we're building a house, the example Warren just brought up, and the interest rate on the money we're borrowing is involved in the price of the house. Well, if the interest rate goes up so high that the cost of building the house now supersedes what you could sell it for, then the house doesn't get built.
Right. But your parents who have, a couple $1 million in the bank were earning 0. Suddenly they're earning 5%. Now they say, oh, you know what? We'll help you out. We've got some extra money. So what you have to look is at the economy as a whole. Does it have more money to spend or less? Okay, so so let's say you're the economy and you're going into the bank and you're looking for a loan. And the loan officer says, okay, well, rates are higher, so maybe you don't qualify so much. And you say, yeah, but my income is up and it's growing. Which is more important? Okay, the income. Now let's say it's the opposite. Rates are coming down. You want to buy a house and you're the economy. And the banker says, yeah, well, rates are lower, so that helps. But geez, I see your income is falling. So when Chairman Bernanke cut rates from 5.5% to 0, the economy lost $400 billion a year in interest income from the government. See, the government is a net payer of interest to the economy. 20 trillion outstanding of what we call public debt, dollars they've spent that haven't been used to pay taxes, that are in people's accounts somewhere in the economy. And I'll trace those for you, but they're all there to the penny. And when rates are 0, that 20 trillion, now some of it's long term, but over time doesn't earn anything. And then as the Fed raises rates, the government's paying interest on all that debt, and the economy is getting a raise. That's what we call basic income for people who already have money, right? And so because the government's this big whopping net payer of interest to the economy, on average, when you raise rates, the government spending goes up on interest, and that's income for the economy. In nominal terms, it gets more dollars. Okay, and so those dollars tend to support growth, borrowing, everything. Even though you can put point. Yeah, go ahead.
Yeah, I was going to say, I want to hammer that point in, that raising rates introduces more money into the economy. The government, or the Fed, or whoever's doing it, is typing more numbers into people's bank accounts.
Right. Yes. That's how you do it.
It's not that they're saying, well, we'll pay more money if you give us more money. They're just adding more stuff into people's bank accounts.
Does this make sense? This characterization of this whole policy?
Yeah.
It's kind of like we have a tax on people who borrow money because there's money that's sucked out of the system that just goes back to the Fed because interest rates are higher on bank reserves borrowed by the banks, which is the basis for the loans they make. So it's kind of like, it's almost like a tax on borrowers and a subsidy to people who already have money, as you said. It's kind of almost like a redistribution.
The banks are not borrowing reserves like that, though.
Sure. Yeah, right.
Okay, so the banks make loans, create bank deposits. But those deposits don't belong to the bank. They belong to the depositor. $200,000 against your house, that loan, the bank will give you $200,000. So that loan created that deposit. You've got that deposit in the bank. But you're going to move that deposit to another bank if your bank doesn't pay a competitive rate of interest. So banks' loans create deposits, but then they have to compete to keep those deposits. And when the Federal Reserve raises rates, the amount they have to pay to compete for those deposits goes up. So they have to pay you more, otherwise you're going to go to the next bank, right? So I just want to point out that central, you said two or three things together. That was kind of in the middle of it.
Sure.
And so if you want to, like, given that a reality of banking.
My point is that my thinking is that when the bank makes a loan, they have to sort of price their loan, right? So I imagine they would use, okay, what is the minimum we have to charge? That's the risk-free
rate.
And
so they look at their cost of funds.
Yeah.
They say, look, my loans are going to create deposits, but I'm going to have to compete to keep those deposits.
Yeah.
As rates go up, they have to pay higher rates to keep those deposits, so they charge more on loans. If I have a bank, I have to look at my cost of funds, what I have to pay my depositors before I go make a loan. So if I have to pay them 1.5%, maybe I make the loan at 4.5%. But let's look at the private sector banking. For every loan, there's a deposit. The loans created the deposits.
Right.
And so they all net to zero.
Right.
So if you raise rates on one, you're raising rates on the other, right? And so the borrowers have to pay more, the savers get more. So what you're doing when you raise rates in the banking system is you're transferring money from borrowers to savers.
Yes.
Okay.
Right.
But the government is a net payer to the economy. Transfer here, okay? They just pay interest on what we call the public debt. All those treasury bills, notes, bonds, paying interest out to everybody. So when they raise rates, they do it by paying more interest to everybody.
Got it.
And so the net for the economy is a huge positive because the public debt is so high. It's not a solvency problem or anything. It's just an income issue. It's just something you can measure, how much income they're adding to the economy. And they're not adding anything for sale. So it's pure demand side. That's your highest risk of inflation when you do that.
That's an interesting point. That because if we compare paying out for bonds and you're just getting money for your money for nothing, essentially, versus government spending, which builds a bridge or gives you food or whatever. The government spending is creating some sort of good or service, which will, as you're making more stuff and you add more money, you're not going to see the inflation as much as you just increase the money supply, right?
Yeah. So look, in government spending, I like to give the example. If the government spent to build the Panama Canal, okay, so they lowered the cost of trade, the cost of transportation for everybody dramatically, and it was a huge productivity increase for commerce for the whole world, okay, for spending that amount of money. And so it was a huge benefit. If they spend the same amount of money to blow up the Panama Canal, then it's a huge negative, okay? So government spending can be like really good or really bad or somewhere in between. Just the fact that you can't just say it's spending is good.
Well, what if we blew it up and then dug it out again?
Now, all those people that did that, could have been out curing cancer or something. So now we're all dying of cancer.
Right, I'm joking.
Yeah. No, well, you're diverting resources that could be used somewhere else. These are all opportunity costs. They're called.
Mm-hmm. Well, and I think that's also a very good point, which is that something I've also seen, particularly from Austrian economics, is that their primary concern is the actual resources moving around.
Yeah.
And while they missed the point on money, I think they've bring up really important points, and like we really need to look at the actual stuff moving around. And what you're saying when it comes to the government printing money, you could move the resources around very, very poorly with the wrong spending.
Oh yeah, yeah, and we've all seen that. So now look, I had a debate with Robert Murphy, the Austrian economist.
Yeah, I watched that debate.
I watched that too.
Have you? Yeah. So what came out of that was that Austrian economics applies to fixed exchange rate regimes. So it's applicable for Hong Kong and Bulgaria today, but not any of the floating exchange rates. So it's nothing wrong with the whole notion of Austrian economics. It's just you have to use it where it applies. Okay, and that's where that's where it does apply. So it's not about right or wrong. It's like, where do you apply it?
So let's talk about floating and fixed exchange rates really quick, because you mentioned before that a government bond at this point for the United States is pretty much anachronistic because we're not a fixed system anymore. Now, right. I could imagine the argument being made that isn't it a good thing that the government has some sort of limit on spending? Because if it has this unlimited spending ability, isn't that an unchecked power for the government?
I don't think so. I think people would rather have high unemployment than high inflation. Because you see it in countries all over the world. When inflation goes up, it's regime change. They'll throw out. China will lose a government if inflation goes up, and there'll be a new one coming in. And you don't have that kind of. The unemployment rate goes up to 25%, but there's no inflation. And the governments are all still there, and they're all still part of the European Union. Okay, so I think there's a disposition in the world at the moment, it might not always be there, to feel that inflation is worse than unemployment. And you can see it in very large doses being demonstrated over and over again.
So China, you mentioned China.
Yeah.
What is the reason why we should not freak out if China decides to sell all its bonds, U.S. bonds?
Right. Well, what would what would the reason be to freak out?
But people are freaking out all the time, right? I mean, there was the scare just a week ago or something. China's going to sell all its bonds, and then the petrodollar is going to explode, and then we're all going to have hyperinflation, right?
Right. It's a lot of headline rhetoric, but none of it ties to any reality.
Well, can you explain what exactly is going on when China is holding all these bonds? What does that mean?
So China sells tires to Walmart. Okay, and so how does China get paid? So the Fed debits Walmart's account at its bank, maybe JP Morgan, on the Fed's books for dollars, and they credit the Bank of China's account at the Fed for $1 billion. Okay, so now China has $1 billion in their checking account at the Fed. It's called a reserve account because it's the Federal Reserve Bank, but it's just a checking account. Okay, so now China decides, is aware that there's such a thing called a treasury bond, which is a savings account at the Federal Reserve Bank. It's just another bank account, and the Fed has accounts just like other banks, but instead of calling them checking and savings, they call them reserve accounts and securities accounts, probably just to confuse us. I don't know. Probably some conspiracy there. But so China says, okay, you know what? I'm going to take my money out of my checking account and put it in my savings account because it earns a little more interest. And I feel better with it in a savings account than a checking account. So it instructs the Fed to debit my checking account, make the number of my checking account go down and make the number of my savings account, the treasury bonds, go up. So now China has treasury bonds. The treasury bonds come due, or China decides they don't want them anymore and they sell them, then their dollars shift from savings accounts back to checking accounts. So it's kind of like, who cares? If Bank of America had a wholesale shift, if China had $1 billion in a savings account at Bank of America and decided to get rid of it and move it to a checking account, it would make the news.
I have a follow-up question on this from an investor. Oh, sorry.
Yeah.
From an investor perspective, I sometimes wonder if entities on the market buying and selling bonds actually really has any impact or should have any impact even on the rates of long-term bonds, for example. Because sometimes we see, for example, we have the scare coming out, China's going to sell their bonds. But in my view, the only reason, the only way the interest rate on 30-year treasuries should be calculated by investors, I don't know if they do, should be their expected cumulative total of all the 3-month treasury bills in that time period, plus maybe some kind of premium that doesn't change. So I wonder, is there actually any impact at all from an investor standpoint on these entities buying and selling even longer term bonds?
Well, there are, because they're very large, and they do it in a very short term. And if you have a pension fund that decides they want to buy long bonds, they might have a quarterly meeting. They have to vote the board of directors, and then they buy them. Whereas somebody like Bank of China could just decide to sell tomorrow. And so you can get short-term dislocations, in price. And the average person would look at it and think it's pretty small. The bond changed by 0.5% because China's selling. And, in bond trading land, that's like, catastrophic, enormous I just took this loss on my trading position. The guy in the street goes like, okay, I got better things to worry about than the rate change by 1% or 0.5%. But that it could mean a 20% change in the value of somebody's bond for 6 months or something. But that's things. Yes, it can move things in a way that's meaningful to leveraged accounts, people who are judged by their weekly performance and things like that. But as far as the macro economy and what the average person's involved in, it's not of any particular consequence. Now, I've proposed for a long time the Treasury not sell any bonds at all.
Right.
Just keep everything, no longer than a 3-month bill, which is basically just cash. Right? So, but if you just leave 3-month bills as the one thing remaining, you don't have to change any laws or institutional structure. Securities, because they're rolling 3-month bills. It's just a simpler way to do it. But then there aren't any of these things, and then nobody has to worry about them, whether they're selling them or not, because there aren't any.
Warren, I want to bring this back up. You mentioned the Fed's checking and savings account, and I remember when I first heard this, it was a mind blower for me because the conspiratorial, one's a Treasury bill and the other one's this other thing, and it's a security, and we got all these fancy language. For normal economists that we're going to click on our mainstream news and read from, they're going to consider one money and one not, right? Whereas both should be considered just money in a different account.
Well, they're both dollars in bank accounts. Once you start using the word money, you're going to have all kinds of ambiguities.
Got it. They're both dollars in bank accounts. Thank you.
Yeah, they're both dollars in bank accounts.
Because
now, under certain definitions, one is money and one isn't, because a long time ago, one was convertible into gold and the other wasn't. And
Thank you. I was going to bring that up.
Yeah, that was the point of the definition, 100 years ago.
Well, and so, and I'd like to segue that into quantitative easing, because when I started being interested in economic stuff, it was when this word quantitative easing started getting thrown around, and everywhere I read, quantitative easing was going to destroy the economy and lead to hyperinflation because the Fed was just simply printing money.
Right.
Now, I've learned from Nima that that's just more, we're just switching between checkings and savings.
Right, exactly.
Can you...
One counts as money, one doesn't. One counts... Yeah, the money in the savings accounts, money, but the one in the checking account does. Now, the one in the savings account actually does count as money under different definitions. The Fed doesn't have one definition of money. They have M1, M2, M3, and then they have an L. And if you go to L, it includes all these savings accounts, all the Treasury securities. And so under that definition of money that they call, that monetary aggregate called L, quantitative easing doesn't change it. It stays the same.
In your opinion,
they don't do that. They go under the narrowest definition of money, M1. They say, oh, look at how much it changed.
Which one's the most important macroeconomically speaking?
I'd have to say L right now, the one that includes everything. The one that includes Treasury securities, for sure.
And would you say that because we're no longer on a fixed system and one's not convertible to gold, so it's kind of
the other ones are
the same thing.
Yeah, the other ones are less applicable today, for sure. They don't give you, the Feds dropped them. They don't even talk about money supply anymore because none of the others, they haven't been able to correlate them with anything going on in the economy. So they just stopped talking about it.
Okay, let's say that again. They've stopped talking about money supply because they haven't been able to correlate it with anything in the economy. Is that what I just heard?
Yeah. And that was back in after Volcker's, absurd experiment, so to speak, where they just stopped using money. And in fact, if you look at the Fed's equations for the economy, there's no money in any of their models. In their general equilibrium models, there's no money in there. It's all relative value stuff. And we have a monetary system where everything's money. There is no money. There are no dollars in that model.
So what does quantitative easing do then? Why even have it? Or is this another deadly innocent fraud?
It's a placebo. And placebos work, right? Placebos cause the Bank of China to dump their treasury securities and maybe lower the dollar so our exports will go up and our imports will go down or something. Or vice versa. It causes people to think they're pumping up stocks or something like that.
So the real effect is that nobody knows what the real effects are, so they react to the fake effects, which are real.
They're real. That this quantitative easing is going to do something. You saw all the reports that came out.
Yeah, it was good. We were supposed to have our hyperinflation like 8 years ago, right?
Right. So people go out and buy gold, right? Which causes gold miners to go out and mine more gold. People that make the tires for the gold trucks to make more tires. Sound effects. Psychological scare effect.
It gives Peter Schiff business.
Buddy.
Yeah, he's next door to you, right? Or somewhere on one of those islands.
Puerto Rico, yeah. I've been on his show before too.
Oh, nice! I didn't know that. I want to watch those.
When I ran for the U.S. Senate in Connecticut, he was running as so each other a few times.
Warren, I'd like to ask, based on your personal experience with banking, because you mentioned you owned a small bank for 25 years. Me and Nima have discussed this, that it seems like most economists never actually walk into a bank and ask what's going on.
I knew Vince Reinhart. I still know Vince Reinhart very well. He was head of monetary affairs for Alan Greenspan and Ben Bernanke. And, he knows this inside out. He helped me write one of my speeches. Okay, so, and he'll tell you that the problem was that these political appointees had zero knowledge of actual monetary operations. How the checks clear? What happens when you buy a security? Where do the dollars get credited and where do the dollars get debited? They just don't understand. They never looked into it. Chairman Bernanke got his PhD studying the U.S. economy in the early 1930s, the Great Depression, when we were on the gold standard, and that's how he understood. And everything he did during the crisis was based on that analysis, which is why it was prolonged for so long for the first 6 months. And yet they'll probably build a statue to him for saving the world, right? But actually what he did was the opposite. I mean, he kept it closer to the brink for a longer period of time.
Can you explain to us, because I realized I have a lot of confusion over this, what happened in the banker bailout of 2008? Now, I understand that our government surplus is the thing that led us into the problem in the first place. And then when the crash finally occurred, there was this huge scandal about all these banker bailouts and about how they were getting relieved by the government because the government was buying up all the toxic assets. And of course, the prediction from this was we're going to spiral into hyperinflation because now the government's spending all this taxpayer money and all these toxic assets, and we're going to flush down the economic toilet. Can you give some clarity on what happened during that time?
Yeah. So the government didn't, to the best of my knowledge, buy any toxic assets from banks. They bought some from the Bear Stearns situation, or maybe from JP Morgan, who was forced to take over Bear Stearns as part of the deal. It was relatively small.
AIG, correct?
Yeah. Did they buy any assets from AIG? I don't think so.
Well, they bought the entire company, basically. The Fed just bought the entire company.
Yeah, but they're not a bank. So if we want to talk about what they did for the banks, that's one thing. What they did for AIG or the auto companies, different, something different. General Electric Credit, they bought their commercial paper. That was a true, bailout that nobody even talks about. Just look at the banks first.
Mm-hmm.
And what I'm going to tell you, the point of the story is to hopefully bring home the fact that none of these people understood anything about banking or how it worked. So what happened with the banks is, I'm going to use some what they call stylized facts, just round numbers to make it easy to understand. Assume a bank like Citibank had $1 trillion of total assets. So what does that mean? What are assets? Well, they had $1 trillion of loans. That was all their assets. Okay, those loans. They had $900 billion of depositors' money and $100 billion of their own money. It's their own money. So they had $100 billion of their own shareholders' money, $900 million of depositors' money, and what did they do with that money? They made loans. They had $1 trillion worth of loans with that money. Well, what happened in 2008 was, let's say, $50 billion of those loans went bad. Okay, so now they only have $950 million of assets because the loans aren't worth as much. They had $1 trillion, they lost $50 billion. All right, so now they've got a problem. When they had $1 trillion worth of loans, they had $900 billion in deposits and $100 billion of their shareholders' money. That shareholders' money, the $100 billion, was 10% of $1 trillion. 10% of the total assets was their own money. $50 billion. They still owed the depositors $900, but now they only had $50 billion of their own money because the loans were only worth $950 because 50 of them went bad. So they lost $50 billion of their own money. And now their own money, their capital, was only 5% of their total assets, approximately 5%. Well, 5% is not enough. It put them in violation. They're supposed to have 10%. All of a sudden, their loans go bad now. Their own money is only good for 5% because they lost $50 billion. Okay, so now the FDIC is supposed to shut them down. Okay, so Sheila Baird at the FDIC, she fires up the bulldozers. They're coming down, Fifth Avenue to get to Citibank so they can take the building down.
Can I interrupt you real quick there, Warren? And, I think this isn't a commonly known fact of that the FDIC has really strong regulations on banks for how much reserves they're supposed to have, what type of loans they're supposed to be making, and all this stuff. And if they don't follow that, the FDIC can come in and just turn them off. Am I right there?
They do. They do continuously. Banks that don't have adequate capital or are in violation some other way, the FDIC will come in and liquidate them. They'll shut them down. Okay? And so they're about to shut down Citibank. Well, nobody wanted that to happen. The economy was horrible, 1,000 points a day. A million people are losing their jobs every day. And so Paulson he was head of the Treasury. And he says, wait a minute, I have $750 billion of TARP money to do something else with, right? He said, how about if I take $50 billion and I buy capital in Citibank, I invested in Citibank. So now, instead of only $50 million, they're back up to $100 million. I'm going to put $50 million in. And now they're 10% rate. They're even a little over 10%. And so you don't have to knock the building down and ruin the whole world economy. So that's the idea. The U.S. Treasury is going to put money into Citibank and keep them from getting bulldozed.
Yeah, preferred stock, correct?
Yeah, whatever.
Mm-hmm.
Stock and that's the way they did it. And they'd have terms and conditions on bonuses and payouts and dividends and
so that was the bailout was simply.
Okay, Obama flies in, McCain flies in. They're both candidates to lobby to get this done because they thought the world was going to end if it didn't get done. And it doesn't pass. And another million people lose their jobs, and the stock market's down another 1,000 points. 4 a.m, mysteriously, it passes. Paulson puts in the $50 billion, and everybody's okay, right? So those were the optics. That's what we were reading. That's what was happening. Look at what Citibank was like before the crisis. They had $100 billion of their own money, which means if they lost more than $100 billion, they didn't have enough to cover their depositors, and the FDIC was going to have to write the check, right? Okay. After now they only have $50 billion of their own money. So that means now all they can lose is another $50 billion, and then the FDIC can come in and write a check, cover the depositors because they're all insured. And so that isn't enough of a cushion. They needed $100 billion of a cushion. Okay, now Paulson puts $50 billion of Treasury money in. Well, now where is Citibank? Well, they still only have $50 billion of their own money. If they lose more than $50 billion, let's say they lose 51 billion, who takes the loss? Well, the U.S. Treasury, Paulson billion that he put in, right? The difference between the U.S. Treasury losing the money and the FDIC losing the money. Okay, nothing. The FDIC gets its money from the Treasury. It's all the U.S. government. It's absolutely no different. Mm-hmm. Okay, so when he put this 50 billion in, functionally, for all practical purposes, absolutely nothing changed. Citibank still only had an extra 50 billion of their own money to lose. And if they lost more than that, the government was still going to pay. They didn't put any money in. There isn't any such thing. If you insure somebody and they have a problem, you can't put your money in to shore them up. That doesn't make any sense. Okay, so so what happened was they gave Citibank, whether they knew it or not, what you call regulatory forbearance. They said to Citibank, you used to have 100 billion. We're going to let you operate with only 50 under these terms and conditions. And there's a whole list. So it was just regulatory forbearance. They weren't putting any money in. They were already on the hook to insure the 900 million of deposits. None of that changed. Okay, the fact that whether Paulson put up 50 billion or not, it didn't matter. At the end of the day, they still have to give the depositors their money and hope that Citibank doesn't lose any more than their last 50 billion. Okay, well, that's okay. It's okay to give regulatory forbearance if you think that serves public purpose for the country. That's what they were doing. They thought they were spending their healthcare money. They were having these discussions about borrowing money from China to put into the thing.
Hold on. Are you telling me that the whole banker bailout was just a poison placebo?
The whole banker bailout was regulatory forbearance. They just let the banks run with less capital, which they're permitted to do.
No, I mean, the whole freak out about the bailout. Everybody was freaking out over nothing?
Yes. Okay. Well, no, regulatory forbearance is something you might want to freak out over. If Citibank's capital drops from 10 to 5 and you let them run with 5 for a while, maybe you freak out because it's too close. That's not enough cushion. But that's not what people were freaking out about. And I don't think they would freak out about that because, it happens all the time. So, but here's the thing. The Fed talking to the staff guys about this. And I tell them this exact story in these same words. And they say, I said, did anybody understand that that's what was going on? They go, no. Until you just explained it, we had never thought about it that way. Okay, so we're talking about everybody at the Federal Reserve, everybody at the top bankers in New York, all the Wall Street analysts, everybody in the House and Senate banking commissions. Nobody in the world except, this one guy down in St. Croix, in a T-shirt and a pair of shorts, understood that these guys were just giving regulatory forbearance and they weren't spending any money. Period.
So the image I'm having in my head is the Three Stooges skit.
It wasn't anything. It was big nothing. Okay, and it almost brought the world down over fear of what it was or what it wasn't or what was happening.
So what was the actual catastrophe of 2008 then?
Car sales went from 17 million to 8 million. Unemployment went up by, 8 million people or something like that. It was people losing their houses. In the middle of 2008, after the Lehman, Bear Stearns and the collapses, and once everything, and I was there even before, I said, look, what we need now is a full payroll tax holiday. This is what I was talking to Stuart Varney about. We just have the government stop taking money out of people's paychecks every week. And so their take-home pay would go up. And the average husband and wife making a total of $100,000 a year would have seen their take-home pay go up by $625 because the government wouldn't be taking it out of their paycheck every week, right? And so all of a sudden, they could make their mortgage payments on their house. Now, what's the difference between a AAA loan and toxic waste? There's only one difference. With AAA, the guy's making his payment. With toxic waste, he can't make his payment.
Okay. So let him make the payment.
Once you support his income, what's that?
So let them be able to make the payment.
Yeah, and then the banks don't have losses, and nobody's losing any money, and there's no bailout. Car sales would not have dropped from 17 million to 8 million if people had an extra $625 a month in their paycheck. They'd make their car payments and replace them when they wear out, just like they always do. It was $1 trillion tax cut. that would have like eliminated nobody. We wouldn't even be talking about it today. Never would have happened. Yeah, and that's from a big spending liberal, right?
Right. Now that I've heard MMT, the evidence, as I understand it, points that this crash where no one was able to buy any cars or keep their jobs or whatever was because of government surplus the years prior.
So what happened was the economy got over leveraged. The deficit got too small, and the whole, the equity supporting the credit structure was inadequate, and the credit structure collapsed to where people couldn't get loans anymore. Okay, banks stopped lending, and so you couldn't borrow to buy a car, you couldn't borrow for your business, and so we just got in a downward spiral. People lost their job. Businesses can't sell anything. People lose their jobs. Now spending goes down some more, so people lose their jobs, and you just get in this downward spiral. And it could have been stopped in its tracks, at the first sign of trouble by eliminating these FICA taxes, which would have been, the government spending more than its income by eliminating the taxes. The spending would stay the same, but the government's income would drop. It would stop taking this money out of the economy, sufficient equity to support GDP.
I've heard you mention this a few times, and I think I agree with you that if we're going to cut a tax, what's the number one tax to cut that would benefit the most number of people in the best way?
Yeah, so that, and that's all about your politics, right? So if you're, from the last tax cut, we could see that what benefited the people who count was to cut the corporate tax. Now, from my perspective, which is now being known as MMT, don't have any corporate taxes to begin with, because they're all pass-throughs to consumers, and so they're highly regressive taxes. And I consider myself, I don't want to just throw on a regressive tax out of nowhere to tilt the balance, because of problem with income distribution. It's caused by government policy that's creating it. And so I don't want to encourage those particular government policies that are causing these taxes and outcomes that are extremely unpopular right now. And so not have corporate taxes. And if you look at the results from this corporate tax cut, I think one of the things you're going to see are prices coming down in the competitive industries, such as a Walmart that's competing with Amazon. If their tax bill goes down and they're more likely to, because they're fighting for market share, they're likely to lower prices.
Interesting.
So they have the same, and that's just what happens in a competitive economy. Now, not with every business all the time. Somebody, like Boeing maybe doesn't do that because they're not in that kind of thing, but maybe they do. They're competing with Airbus. Yeah, but there could be some defense contractors or whatever that just keep the money. I'm not saying everybody's going to do this, but in general, if you have a competitive economy, which there are a lot of reasons to do things to make sure there either is a competitive economy or where it's not competitive, it's then you have to properly regulate it. And a corporate tax brings down prices. And when eliminating the FICA tax also was going to bring, the corporations pay half of that. It's 7.6%. Okay, and so in competitive situations, it would have been deflationary. Prices would have come down.
Well, and then I think it's important to point out when you say that for the FICA tax that your employer pays half of that. So to eliminate the FICA tax, you're putting more money in everybody's pocket.
Yeah,
the employee and the employer. So the employees have more money to spend, and the employer can bring the prices down.
Yeah, well, they compete with each other, so they'll wind up bringing prices down if your competition is set up properly. And so if you have a competitive environment. And so it becomes deflationary. It doesn't cause inflation. Okay, if anything, it makes everybody richer. You have more money and things get cheaper. And that, you're not getting something for nothing, by the way. You're getting this because what we had before was restrictive.
Right.
For nothing, just by. So my analogy is you've got a runner who's all trained and ready to go into the Olympics, and then you put a plastic bag over his head. and then he can't run anymore. And so I say, look, let's take the plastic bag off this guy's head and let him run. And you say, oh yeah, you want to put him on drugs and steroids. It's like, no, I'm not giving him a stimulus. I'm removing a restriction.
Right.
So I'll never call fiscal policy a stimulus.
I also want to get your general opinion on the new tax law, because as an economist and a banker and an entrepreneur and an individual, obviously, you get to see all sides of all the taxes. And I'm an entrepreneur as well, and I've been following the tax changes, and I've noticed that there's really three subcategories of taxable entities, which is the individual, the small business, and the big business. It looks like the big businesses did awesome in this new tax bill, which is great for everybody, as you just pointed out, and the individual and the small business did okay. What else would you have liked to have seen within this tax bill that you think could have been possible?
So I get pretty extreme on taxes. I don't think there should be any corporate taxes. I don't think there's any economist who would dispute that. I don't think dispute my other position, which is healthcare should not be a marginal cost of production. It shouldn't be paid for by businesses and be part of their cost structure unless the business itself makes people sick. People don't get sick because they're working. So to make that a marginal cost of production just distorts the whole price structure of corporate America and everything else. So, for the worst.
Well, and the history that I understand is that the reason that that's a marginal part of the price structure, part of business, is during World War II, when businesses weren't allowed to give raises, they offered health insurance to their employees to give them something more, and we've just been stuck with it ever since.
Yeah, and there's always like a good reason for all this stuff historically. An optimal way to do things by any means.
Right.
It's a major distortion of the system. So we're stuck with that. So transactions taxes in general, like sales tax, VAT tax, income tax,
they're wicked.
They make us poorer in the sense that in economics you have what's called comparative advantage and economies of scale. And in simple terms, it's like, if I'm a barber, cut hair, and my neighbor's guy, I want me to be cutting my own kid's hair and my neighbor's hair. And I want him to be doing his landscape and my landscape. You don't want me to be cutting my kid's hair and doing my own landscape and he cuts his own kid's hair, because then, my landscape's terrible and his kids look terrible, right? So doing things for each other, specializing, makes us all richer. And economies of scale makes us richer. If I'm cutting 10 kids' hair or cooking for 20 people, it's more efficient than just cooking for one or two people or just giving one haircut once in a while because of the equipment and everything else, duplication. And so because of these things, you don't want to do anything to restrict us from doing things for each other, with each other, right? And so when you put taxes on these transactions, if I want to hire you, I have to pay a tax. You're going to pay an income tax on the income, or I've got to pay some kind of employee tax. If I want to hire you to cut my trees, I have to pay a sales tax or value-added tax. If you give a haircut, you charge a tax. It all restricts it. We do fewer of these things and do more things for ourselves because of this tax system. It's higher when you try to hire somebody to do something or provide a service. And so you tend not to do it. You tend to do things for yourself. And we're all poorer for that by large margins. So I'm categorically against transactions taxes on beneficial transactions. Now, there's some transactions you don't want to happen. And so you could put a high transaction tax on to make sure it doesn't happen. Maybe
what's an example of a transaction we don't want to happen?
Well, maybe you don't want somebody cutting down the rainforest, so you put a heavy tax on trees from the rainforest. But of course, you better to just ban it, but maybe you put a heavy tax on. You don't want people to smoke, so you put a heavy tax on cigarettes. And then you see the congressman get up there saying, we got to be careful about the cigarette tax, because if it gets too high, people will quit smoking. Well, that's the whole point. It's not to make money. You put taxes on alcohol to try and keep people from drinking, things like that.
On the tax, oh, sorry.
Yeah. And they talk about a carbon tax to keep people from using carbon. Now, I'm generally against even those types of transaction taxes because they're generally regressive. They're generally paid by people who can afford it the least. The people who can afford to pay it,
they don't care.
As large a carbon footprint as they want. They can drive as large a car as they want. They get 3 miles a gallon as long as they're willing to pay the price. And so it turns out to be ugly regressive to do things that way. And there are better ways to do those things than ugly regressive. So anyway, so for our tax system, that it all comes down to like property tax on your land and nothing else. Okay, there's no compliance cost for property tax. We already have them everywhere. The federal government tacked on a 5% property tax or something and eliminated everything else. Income tax, sales tax, nothing. Everything's gone. Except that. I think, GDP might increase 15 or 20%. If you look at the amount of people tied up in compliance with all this government stuff.
I'd guess like 100, but
yeah, maybe it is. I'm trying to be conservative here. This is a conservative network, right?
No, we're anarchists around here, man.
Oh, anarchists. Yeah. Yeah, no. And so you still need to drive the currency, but look, with the property tax, you don't even have to know who owns the house. If it doesn't pay the tax, you sell it. So the government doesn't need to know how much money you make or what you've done anywhere. The only reason they need to know all this stuff is because they tax it. Once you've eliminated the taxes, then the need for all this record keeping and information flow and these horrible interactions with these government agencies like the IRS and the legal system, it all goes away. All these tax lawyers, it all goes away. So
you're not actually suggesting we should starve tax lawyers, are you?
No, I think they should go out and do something else.
Well, they can't. They're tax lawyers. Sorry.
Yeah.
My jokes are falling short.
Yeah. Yeah. Well, they could go out and, stuff animals. Oh, that's tax attorneys. Tax attorneys.
Okay,
that's
so
good.
we'll just miss each
That's
other with
fine.
our jokes for the rest of the show. How about that?
Yeah. No more punishment. Okay. So, all right. So we can, so what I say is, all right, clean sheet of paper. We wouldn't have any of this. We'd have a real estate tax and nothing else. Maybe an asset tax on cars so that we could make sure, or regulations to make sure we get at least 50 miles a gallon because we don't want a lot of fuel just because they have money. We want to make sure you can't do it. And so, you do things like that. But how do you get from here to there? So you have to somehow and to get from here to there. And we're not doing that. Now, getting rid of some of the corporate tax in a very piecemeal way, in a way that favors one group over another, is a step to get us from here to there. Okay, now whether we ever take another step or not, I don't know. And the fact that the first step we took is highly regressive is not particularly satisfying for me. But
well, that's one of the reasons why we want to have you on, and that we're trying to make videos like this is because there's a lot of people, as you mentioned in the beginning, who will simply reject this because they simply don't want to listen to you and they have a political agenda. But I believe, and I think Nima believes the same thing, that there's a lot of people who simply don't have the information and they haven't had it explained to them properly.
Right.
And I'm trying to create something where people do have that opportunity.
Yeah. Yeah. Okay. So anyway, is that enough on the tax bill?
Well,
or do you want more on that?
I just wanted to say, I think you may have answered, because I wanted to move in this as well, is if federal spending is not constrained by tax revenue, but we need a minimum amount to give value to the money in the first place. What's to stop us from simply going to the absolute minimum required and just drawing the line there? Is there any reason not to do that?
No, there's no reason not to do that. It's right now I would say we're grossly overtaxed. And so the answer is either to tax less or spend more, or some combination, depending on your politics.
Mm-hmm.
The deficit's not nearly high enough. It's the money supply for the economy. It's the dollars spent that haven't been used to pay taxes. And right now, for the most part, the economy is starving for money, for equity, and so I would say, there's a lot of excess capacity in this economy right now, and the excess capacity is the evidence that the deficit is too small. And again, that we're grossly overtaxed for the spending we have.
Mm-hmm. Well, that's roughly what we had on our list of things to talk with you about tonight.
Okay,
you nailed them pretty good. Is there anything else that you wanted to add?
Well, just feel free to call back and back and fill all you want. So it's not I don't have any format. I've been doing this for a long time, trying to get the word out as to how this all works, and you guys are part of the answer. So I'm looking forward to doing as much of this as you want.
We super appreciate that.
Thank you so much.